I wanted to come on and talk about three quick items. One, the second quarter, which just ended. Second, the jobs report that was just released. And then third, oil. I want to talk about oil demand. So if you look at the second quarter, we obviously had a lot of geopolitical risk, yet the market performed exceptionally strong. What's really interesting about the second quarter is it is one of the highest that we have had in history in terms of single stock volatility. So again, we're getting these really violent rotations underneath the surface, but you're really not seeing it in the indices themselves. And what I think is important about that is really making sure that you are diversified. I think that diversification can really provide alpha in market opportunities or market environments like this one. So that's one point I wanted to bring up, and I do think that volatility is going to continue for the foreseeable future. Anytime that we have a lot of innovation, you also have destruction that's associated with that, and that's what really causes these big violent rotations that we're getting. Yesterday was a good example with the announcement with Meta. Meta is selling some of their overcapacity on the cloud computing side, and we saw the big sell-off in the hyperscalers. So again, seeing these really big moves one way or the other with different securities. Second is the jobs report. The jobs report was actually weaker than expected, and it's the first one that we've seen weaker numbers in a number of months. The market is up today, and so why is that? It looks like it's taking pressure off the Fed to raise interest rates. So obviously there's an ideal scenario where we want to see the economy cooling off a little bit and inflation cooling off a little bit, but we don't want to see the economic environment deteriorate too significantly. So that Goldilocks scenario is what we're looking for. Lastly, it's interesting, oil prices continue to decline. Coming into this year, the United States was in a position where we had we were projected to have a very large surplus of oil, almost I think it was between 1 million and 1.5 million barrels a day. China's uptake of oil that is now coming through the strait has not been near as significant as what people expected. So it does look like the read-through is the Chinese economy is weakening as well. So again, we want to watch those trajectories, but it's encouraging to look like the pressure is off the Fed to act. Thank you so much.